understand the CAS pathway a bit more. Ooh, that's really tiny, so I might have to just refer to my trusty phone over here. So the first set of exams, the ones that are in green, are the preliminary exams. So those cover first the validation by educational experience. So that, thank you. So that is very similar to the SOA. I know you guys are familiar with that. And then we have our exam 1, which is probability, same exam P. Our exam 2, which is exam FM. So I think you guys are familiar with that. And we also have our data and insurance series courses. We refer to them as DISCs. So those cover introduction to data analytics. Yes, and that came about mostly because of what's going on with data science. We've got a risk management course, and then we have one that's insurance accounting and coverage terms, etc. Then if you go down to the second line of courses, those are our ACAS courses. So we have Modern Actuarial Statistics 1 and 2. So those exams focus a lot on statistical modeling. We have our course on professionalism. I think that's standard for most actuarial bodies. And then we have the real, I think this is when you really get into science. And then we've got exam 6, which covers regulation and financial reporting. We actually have that one split into multiple exams. There's the US version, there's the Canadian version, and there's the international version, which covers things like IFRS 17, which is not covered by the US. And then we have our FCAS exam, so that's what you're seeing in gold. We have exam 7, which covers advanced reserving. Exam 8 is advanced pricing, and then exam 9 is advanced risk management. So I think, as you can also see, that once you have an FCAS, you don't actually have to get a second ERM credential. I mean, for those that are interested in ERM, because it's actually built into the CAS pathway. So many of us transition between, typical actuarial pricing, reserving work, and ERM, like I did. I was a reserving actuary before I moved to Africa Re, and I now do ERM. So the next slide, please. So this covers the early requirements a little bit more. So there's the VE, which I know you're familiar with. Very interestingly, across Africa, it seems a lot of people are actually taking exams for that. So we're trying to change that. I mean, this is from the CAS side, from the ADA side as well, African Actuarial Development Academy. And hopefully, and please monitor that, because we're going to have a few sessions over the next year on how to get VEE credits for your courses. And then exam 1, actually, I think I mentioned it correlates to exam P, but for those of you familiar with IFOA, it's the same as CS1. For those of you doing the ASA exams, it's the same as A111. I think that's how you call them, A111. Anyway, and then exam 2, same as IFOA, CM1, same as ASA, A211. Next slide, please. So the CAS also has a waiver for preliminary education, because we actually do not necessarily offer the preliminary exams ourselves. So for example, exam P, it's the same as the SOA one. We don't do it separately. Exam FM, same thing. So this table shows you how you can get waivers for the various exams that you take with various bodies. And as soon as you get the pass for it, we accept it. You just have to give evidence of your pass, and then that's it. So for SOA, typical ones, VE, exam P, and FM. IFOA, we've got, I think, the 5 first exams, which are typically also the ones that you get university accreditation for. I heard somebody talking about university accreditation. I think it was your president, that's going to be happening next year for a few universities. So you can take a look. They usually are the same ones that CAS gives a waiver for. So the benefits of pursuing CAS credentials. So something people say a lot about the CAS is that the exams are directly applicable to your work. In fact, I met a candidate in Kenya who he actually skipped a couple of exams and went straight to exam 6I, which happens to be an exam people try to avoid, but he went straight to it because it covered IFRS 17. And he looked at me, he was like, Yvonne, all my problems at work went away especially if you're looking for research, if you're looking for continuing education credits. We have got 5 large conferences that happen each year, in addition to other smaller regional ones. So there's like one conference just based on pricing, one conference just based on reserving, one conference just based on reinsurance, and then 2 fall and spring conferences, as they're called, which have, that's where we recognize the candidates when they get their ACASs and FCASs. And then there's also some business meetings as well as continuing educational credits. Next slide. So, interesting thing, I don't know if you guys knew this, but the CAS actually provides exam discounts of 75% for all candidates in Ghana. So our discounts are not individual based. I know some entities do that. They're country based. So if you are based in Ghana, you get 75% off all our exams. And it's easy process. It's on the website. You just follow it. Done. Next slide, please. And then also, for those of you who realize that, oh, darn it, I should have been a CAS actuary, and you got another credential. Now that you've heard this presentation, you're like, oh, yeah, it's the one to go to. We do have affiliate membership, which you can join. So you can scan that code to learn a bit more about affiliate membership. We currently, affiliate membership for people based internationally is about 1/10 of the price of everyone else. So again, the CAS is intentionally doing things to make sure that we're helping and reaching the international market. So do check it out. You get access to all continuing education opportunities. You get, and we also have loads of research. So I'll point out to you guys the practical strategies for IFRS 17 implementation in Asia. I know that's not Africa, but probably he's not there. Where is he? Over there. You can speak to him to find out more about the CAS. Thank you.
All right, please, any question? Please, can you hold on? Any question? I believe with the ongoing Milliman UNDP GAIN project on the development of non-life actuarial profession in Ghana, this is a very good year to move to. Any question, please? Any question? No question for Yvonne? Yvonne, you are safe.
Thank you, guys.
Okay, thank you very much. So our next section, we are going to explore how we're going to move from calculators to using our architecture. So moving from calculators to architects. And we have a representative from QED, Henry, to lead us in the actuarial role in shaping market disclosure. Please, a round of applause for Henry.
Good afternoon. Good afternoon. The lunch was heavier. Yeah, I've been given the most challenging session just after lunch. So thank you very much. I must admit the warm hospitality, having been received well, truly amazing. I've enjoyed the food, chicken, fish, but the pepe, a bit too strong for me. So we'll talk about market disclosures, what exactly that is. So for some, probably our seniors in the audience might be nothing really new to them. But we'll begin off by giving context. So if we move to the next slide, just setting context so that you're all on the same page. where we shall define what market disclosures are, what's their role, who uses market disclosures, the categories, that's number 4, some of the matrices, and number 6 should have been challenges. I've repeated their defining, but it should be challenges. And then the next part is in the next slide. Sorry, you've moved a bit faster. Is we'll see some examples. Actually, one example I had two, but in the interest of time, I removed one. And we'll then talk about what role as the actuarial profession we play in, and a case for Ghana. So when we talk about market disclosures in this context, I would like you just to think just yourself as a consumer. I'll give a case in Kenya, actually a very personal one, where unfortunately one time I was unwell at work. So I walked to an outpatient hospital, part of our benefits that we have, and I got seen, but I was too unwell to go home, so I called my fiancée then to take me home. And when she came to pick me up, she, adamantly and very, concerned asked me, "Who treated you?" I just said, "It's the doctor." "No, who treated you?" "It's this doctor." "No, I want to see the name. I want to see the doctor who treated you." So eventually, I just pointed her, I said, "That doctor." And, I could just see she held her head. Long story short, turns out I was treated by a quack. And by that time, I'd gotten some injections, some medicines. And fortunately, it turned out that it was nothing more than, nothing too dangerous. And that's the context when we talk about market disclosure, in the sense of who should have been there to protect me, to ensure that, I'm dealing with a qualified doctor. It's a story for another day how, the story came out. And that's the context in which I would like us to put ourselves in terms of the financial space. What sort of information, whether you're insurance, whether you're insurer, whether you're in a scheme, pension scheme for that matter, for a medical scheme, what information should we be disclosing to users of the financial system? So when you think about market disclosure, it's the dissemination of information. More often than not, it's information that people have not really asked for. So if you think about like an audit, it's an auditor who comes and asks you, right? But with market disclosure is about putting out the information out there to create transparency. And if by any chance you've come through something called, information asymmetry, where one party knows has more information than the other against market. I give one example. We were helping a client. They wanted to expand into another market, another country within East Africa. And we had a lot of challenges getting information in that market, right? So, all those nice financial projection models we do, so it was just a struggle even just setting assumptions. So as good actuaries, what we do a lot of scenario testing, sensitivity analysis, and all that. It eventually ended up that to cover much of the risk that was not captured within the assumptions, they told inflows, right? For people to buy and sell from a transaction perspective. But then it has a negative impact on solvency. And because you disclose solvency, then people will think twice about that. UFA, unclaimed financial asset. So in this particular case, an audit was done, a sample of them, and I believe actually the total amount was about close to, so I said 800, so about 1.6. So just one financial institution carried 50%. So it's expected that reasonably when consumers see this sort of disclosure, you can imagine the sort of reaction they will have towards that particular provider. And we see disclosures also complementing, so that's the last part there. complementing the regulators, particularly where there's voluntary disclosures. So where it's mandatory, you're doing what you are being told to do, right? But if you go over and beyond that, you're creating more confidence in your market. You're supplementing the regulator further, and broadly, you're helping the financial system. Skipping all the way, if I can get help there, we'll just click continue. Please proceed. So that's all. That's published, right? Really mean quite a lot. So will be mapped out and identifying what information matters. So if you think about a policy holder, does it really help them to know that your ALM mismatch is out by X million? Probably not. But maybe to a client, it's more important for them to know, for example, claims are paid within X days. I did read that in Ghana, in the insurance market, there are guidelines on claims. Payment, I saw about like some claims are 3 days, others are 5 days. So if you did a disclosure to say we pay claims within as stipulated or outside as stipulation, what does that mean? The type of market disclosures, moving on to the next slide, it's a bit context heavy, it's a lot of information, but I'll just break it down for you. There are different levels of information. There's information that's mandatory, and there's information that's voluntary. So that's on the right side. And I'm just thinking about the presentation that has been made here about pension, how longevity is coming through. So when you think about those improvements, to whom does that information matter? So for example, I would say that should be mandatory information that needs to reach the key decision makers within, say, the government, so that when policy is being formulated, so it was interesting to hear about what retirement age in Ghana means. In Kenya, it's different. You'll even have, for example, special civil servants jobs having much older retirement ages. So for example, judges and professors, they can retire up to 75. So it's different all the way from 60 to 75. So when you think about mandatory and voluntary, think of it that way. You can also have a mixture of both. Without really going into the detail, it's really appreciating the type of information you want to go through and provide. If you're a company that's yet to be listed, so thinking of an IPO, right? There's a lot of information you need to put out there. If you're an insurer, I encourage you to go through to the insurance core principles issued out by the International Association of Insurance Supervisors. They have quite a lot of detail in terms of disclosures, and just see, and you'll see some of the information there is actually in your FCRs that you do. In terms of the next slide, so what sort of disclosures are there? The number of disclosures are quite numerous, and it's not the idea to go through each one of them in detail. There's quite a lot. So whether it's about solvency, market share, market penetration, your assets and investments, all these are critical information. Going back to the example that I shared about the client that was looking to expand into a new market. So we couldn't find information on balance sheet, the types of assets. So even just setting an assumption on investment return was quite a challenge. So think about the different sort of matrices that are there. If you go to the next slide, you can see there are 14 buckets. Just go a slide back. There are 14 buckets. And out of those 14 buckets, you have about 150 matrices. So think about, as a market, there's quite a lot of disclosures that you can provide. There are a lot of users, but I can't pronounce the full name there. And what this index does, it's a measure of market concentration. So think back to your economics class. Think about, what are they called? Monopolistic market, a monopoly, oligopoly. So in this case, 10,000 being the highest and 1 being the lowest. 1 means it's a perfect market. There's a very good level of competition, 10,000 being it's a monopoly. And one of the measures, one of the ways this measure is used is actually used to assess anti-competition. So for example, if 1, 2, 3 insurers decide to merge, it can be used to see if it's going to make the market the more cost it is. So a very good example is IFRS 17. You will, and it's something we see, probably you've seen it in the market, where insurers with multinationals, headquarters, had it easier than the smaller companies. So there's definitely cost in that. We also see where there are no mandatory disclosures, where there's voluntary disclosures. People select what they want to disclose. And also people select what they want to disclose and how they want to disclose. So there's no standardization. So for example, we could go and say, as an industry, it's important we disclose, for example, how quickly we pay claims. But then how one company does it and the other, we could all decide to do something that's different. Without going into details, I'll skip the slides that follow and just go through an example in India and see how, next slide please, how their disclosure in persistency has been done and what benefit was there for them. So just for context, India had one large insurer, the state-owned insurer. Then a couple of years back, it was liberalized, so there are a few new players that came in. But the market is quite large. It's the 10th largest life insurance market in the world. So one of the, next slide, one of the matrices that they put through is persistency. So persistency essentially is looking at the rate, how much or what proportion of your clients you're still retaining. So if you look at, in India, they look at it from 13th month, 25th, 37th, 49th, and 61. So basically, the clients who joined 13 months ago, so which is basically a year, what proportion are still remaining? The clients that joined 20, example, and eventually the regulator is targeting the first year persistency to be 90%. For those in life insurers, I'm sure that's a very mouth-watering sort of ratio, right? And the 61st persistency at 65. And what the regulator has used this is essentially to say, with the 13th month, so basically your year one, it's an indicator of customer satisfaction. So the higher it is, it means that there's a correlation of your products meeting the needs of the customer, that the selling practices of the company match the needs. So they are using that and they've seen significant improvements. And one of the outcomes of the persistency improvement is, and I do stand corrected, I'm not too familiar with the Ghana market, but like in Kenya, we have the guideline that if you're doing any product that has a surrender value, your surrender value must start at least from month 37, so basically 3 years. So there was a very improved correlation of persistency and solvency. There's also a very improved correlation of persistency and claim payments. So when they do the ranking, they also disclose what proportion of claims are paid. The companies that have the highest market share have the best persistency, have the best solvency ratio, have the best claimant payments. So here's a challenge to those in the market. And probably I'm using insurance just by an example, but you can extend it. If we were to disclose all these matrices, how do we think we would fare? Would our customers run away from us, right? Would it pose a challenge to explain to customers what's happening? Yeah, so food for thought. I'll skip the next slides. It's going into a bit more detail. Probably this is a bit small, but when we will definitely share. But essentially, there's a standard format that the regulator has provided in terms of disclosure. So I've talked about the 13th, 25th, 37th, 49th, and 61. So remember what I talked about, disclosures being standardized. Otherwise, everybody would essentially do their thing. So they've come up with a very standard way. They've also done it such that disclosures are done every quarter. So if you think about your actuarial